At this exact moment, 20% of the world's daily oil consumption is physically trapped. Commercial transit through the Strait of Hormuz has completely frozen. While Washington and Tehran exchange unworkable ceasefire proposals, the global supply chain is violently fracturing. The headlines are focused on the diplomatic theater, but the real war is already being waged in the commodities market. The era of frictionless global trade has officially ended, and the financial markets are about to open to a stagflation shock that will permanently alter institutional capital flows. The West is bleeding, but the East is buying. I am Suri. Welcome to the macro shift. Today, we map the exact mathematical fallout of this blockade and how it will dictate the charts for oil, gold, and equities at tomorrow's opening bell. The political rhetoric means nothing. The maritime tracking data means everything. Let us look at the exact volume of wealth that was removed from the global economy in the last 24 hours. The map confirms a total logistical paralysis. The catalyst for this freeze occurred precisely 48 hours ago when major maritime syndicates in London revoked all risk coverage for vessels entering the Persian Gulf. This was the culmination of a week-long build-up. 7 days ago, back-channel negotiations collapsed, prompting Tehran to initiate unannounced live-fire naval exercises directly across the shipping lanes. This is not a traditional military blockade. It is a weaponization of financial risk. Commercial shipping conglomerates cannot legally move assets without insurance. The United States Carrier Strike Group, despite its kinetic supremacy, cannot force insurers to underwrite billions of dollars in vulnerable corporate assets. This insurance freeze has created an immediate exponential spike in global freight rates. If you want to understand why inflation is about to surge, you must look at the Baltic Exchange data from this morning. The rerouting of global shipping adds 14 days to transit times and quadruples logistical costs. For the United States, this represents a catastrophic macroeconomic vulnerability. Historically, Washington could suppress these geopolitical price shocks by flooding the market with domestic reserves. That mechanism is now impaired. The U.S. Strategic Petroleum Reserve sits at critically depleted levels, hovering near 360 million barrels, levels not seen since the 1980s. Washington is cornered. If the Federal Reserve cuts interest rates, they fuel the inflationary fire of $120 oil. If they hold or raise rates, they crash an over-leveraged domestic economy. Tehran understands this mathematical trap. Iran is willing to absorb short-term export losses because they know the West cannot absorb structural stagflation. But Iran is not suffering a total embargo. A massive shadow fleet is moving millions of barrels entirely outside the SWIFT system. We have the satellite tracking of where this discounted crude is landing right now. The data is unambiguous. China is the primary beneficiary of this geopolitical friction. By purchasing sanctioned Iranian crude at an $18 per barrel discount, Beijing is securing its industrial base at a fraction of the cost paid by Europe and America. This grants Chinese manufacturing an insurmountable margin advantage in the global export market. Simultaneously, Russia is capitalizing on the supply vacuum. Operating outside the Hormuz chokepoint, Moscow is rerouting its Ural crude directly to Asian markets via secure overland pipelines and the Northern Sea route. As the Brent crude benchmark spikes on fear, Russian state revenues scale proportionally. The West's energy crisis is directly funding the East's geopolitical expansion. This divergence in energy input costs is aggressively fracturing the balance sheets of nations caught in the middle. The macroeconomic damage to India is already printing on the currency charts. Nations lacking domestic energy security are absorbing the full kinetic impact of this trade war. India, importing over 85% of its crude oil, is structurally exposed. Every $10 surge in the price of crude aggressively widens India's current account deficit. To finance these expensive imports, the nation must sell rupees to buy US dollars, triggering rapid currency depreciation. The Reserve Bank of India is now in a highly defensive posture. They are forced to maintain restrictive liquidity to defend the rupee, which systematically chokes off domestic growth. When the market opens on Tuesday, foreign institutional capital will execute a rapid risk-off rotation. The Nifty 50 will face severe overhead supply as investors flee emerging market equities that are dependent on imported energy. When fiat currencies depreciate and equities face systemic risk, institutional capital does not wait in cash. It moves to the ultimate borderless Tier 1 asset. Look at the accumulation volume in gold over the last 72 hours. Gold is no longer behaving as a simple inflation hedge. It is mathematically pricing in the balkanization of the global economy. When the U.S. Navy cannot ensure the safe transit of global commodities, the foundational premise of the petrodollar is broken. Sovereign wealth funds and Eastern central banks, specifically the PBOC and the RBI, are aggressively converting U.S. treasuries into physical gold. Gold carries zero counterparty risk. It cannot be sanctioned, and it cannot be trapped in a blocked strait. Tomorrow morning, expect gold to gap up. Do not look for deep pullbacks. In a structural supply crisis, algorithmic dips are immediately absorbed by sovereign entities. While gold protects sovereign wealth, silver is preparing for an industrial supply squeeze that will generate extreme volatility. The physical deficit in the silver market is staggering. Here is the data. Silver possesses the monetary attributes of gold, but it is tethered to critical industrial demand. As the Middle East destabilizes, Western governments are accelerating capital deployment into domestic solar infrastructure and defense manufacturing to secure energy independence. Both sectors require massive, inelastic quantities of silver. We are currently operating in a multi-year structural deficit for physical silver. Up until now, paper derivatives on the COMEX have suppressed the price. However, as supply chains fracture, industrial consumers are demanding physical delivery over cash settlement. When Tuesday's opening bell rings, expect aggressive short covering in the silver market. The violent upside price action will outpace gold on a percentage basis. To predict exactly how institutional traders are positioning for Tuesday, we must look past the spot prices and analyze the futures market. The crude oil curve is currently flashing a severe panic signal. The steep backwardation in the crude curve indicates one thing: sheer panic for immediate physical supply. Institutions are paying massive premiums to secure oil today because they calculate that the Strait of Hormuz will remain offline indefinitely. For equity markets, this triggers a brutal sector rotation. We will see capital violently exit consumer discretionary, highly leveraged tech and retail. That liquidity will flow directly into domestic energy producers, maritime logistics companies operating outside the Middle East, and defense contractors. Do not attempt to catch falling knives in tech or emerging market equities this week. The market must digest structurally higher input costs, which means corporate margins will contract across the board. This is not a temporary market correction. We are mapping a permanent shift in global inflation dynamics. Let us overlay the new macro reality. The era of just-in-time logistics is dead. The balkanization of the global economy is accelerating. Nations now realize that maximum efficiency is a fatal liability when choke points can be closed overnight. Moving forward, governments and corporations will prioritize resilience over cost, permanently onshoring critical supply chains. This deglobalization is inherently inflationary. We are entering an extended period where high interest rates and sticky inflation are the absolute baseline, funded by massive sovereign debt issuance. In this environment, a traditional 60-40 portfolio of broad equities and bonds offers zero protection. Capital allocation must adapt immediately to this new multipolar reality. Look at the asset classes that will define the next decade of returns. The rules of capital preservation have permanently changed. As you position your portfolios for the Tuesday open, ignore the political noise. Monitor the diplomatic wires carefully, but do not trade the headlines. Trade the reality of physical scarcity. Follow the sovereign accumulation of gold. Track the premiums on physical silver delivery. Monitor the backwardation in the energy markets. They are showing you the undeniable reality of the macro shift. Expect elevated volatility. Expect sudden gap downs in broad equities. We will be tracking the exact volume flowing into the energy and metals ETFs minute by minute as the market opens tomorrow. I will provide the updated institutional footprint in our next brief. The chessboard has been reset. The unipolar economic order is unwinding in real time. Stay objective. Remove emotion from your execution. Manage your risk parameters ruthlessly and align your capital with physical, borderless value. I am Suri. This has been your analysis. I will see you at the opening bell.